SCHD not really doing as bad as the market is making it seem? Let's find out. Currently, SCHD is down about 6.5% this year, and SPY, the 500 largest US companies listed on the stock exchange, is up 9.62%. This means SCHD is trailing the overall market by over 15%. Because SCHD or SCHD has underperformed the market over a 6-month span, many investors are quickly selling out of the fund because of the stocks only go up mentality. However, history would show it's actually very normal for the market to experience downturns or sideways markets for prolonged periods of time. But the market has always reached new all-time highs. The S&P 500 fell 38% in 2008 during the last financial crisis. But those who were buying up shares and buying up assets easily became millionaires, as the stock market has returned 14% annually since the start of 2009. Even the stonks only go up investors who only bought at the top, even they are still doing really well in the long run, because we're all doing laps around the majority of people who do not invest at all and they live paycheck to paycheck. But getting back to SCHD and the S&P 500, you hear S&P 500 and you think all 500 companies are of equal weighting. They're all the same size. The S&P 500, after all, has a combined market cap of $34 trillion. However, not all companies are made alike. The largest company in the world, Apple, has a market cap of $2.8 trillion, meaning one company is responsible for 8% of the entire S&P 500 index. Apple stock is up a blistering 40% year to date. The second largest company by market cap is Microsoft at $2.4 trillion, and they're up 33%. Google at $1.5 trillion is up 38% year to date. Amazon at $1.1 trillion is up 35%. Nvidia at $800 billion is up 118%. Warren Buffett's company, Berkshire Hathaway, has a market cap of $700 billion and is up a whole 8% for the year. The 6 companies I just mentioned make up almost 1/4 of the entire S&P 500 market cap. That is absolutely absurd. If we throw in Facebook, Tesla, Visa, and United Health, that number balloons to 10 companies, making up 1/3 of the index. That means that these 10 companies easily have the power to sway the general return of the index. And most of these companies are in the tech sector and have had an amazing 2023. The market is very top heavy. Just a few companies are propping up the market in what would otherwise likely be close to a flat or negative return on the year. I'll actually show you what that real number would be here in a second. SCHD, on the other hand, has just 12% exposure to tech and 0% exposure to any of the top 10 largest companies by market cap. If the tech sector did poorly, SCHD would probably be beating the market. Take, for example, in 2022, tech got clobbered, being down nearly 30% overall, and the S&P 500 was down 19%. But SCHD was down just 3%. It destroyed the tech sector and the overall market. We know throughout the years, different sectors will be big winners or big losers. If we take a look at the S&P 500 by equal weighting, such as with an ETF like RSP, which equally weighs the 500 largest companies of the S&P 500, we can see the return is only plus 1%. So yes, SCHD is still lagging, but not by as much when Apple is in a ridiculous 8% of the total index. Just a few big tech companies are making SCHD look bad. Right now is not SCHD season, but these other sectors will rebound and they will do well, especially because most experts think that interest rate cuts are on the horizon. The Federal Reserve greatly influences the stock market. When interest rates are high, credit is more expensive and harder to get. Therefore, people are less likely to be spending money, and companies are less likely to be investing in research and development and doing that next big building expansion, and economic growth is limited. The stock market also doesn't do as hot as a result. When interest rates are low, it's much easier to get loans, people take more risk, companies will spend more on people and R&D, and stocks become more attractive. And people are more likely to spend money and the economy expands. Check out the Federal Reserve Controls the Stock Market video if you want more info on this. I absolutely love the simple comment that Square Mile left on my last video about SCHD. Relax and stop watching it every day. That's it. That was the comment. Such wise Warren Buffett-like words. Dividend investing is a long-term investment. It's not a let me check the share price every hour and make stupid decisions type of investment. So right now, I'm just going to keep scooping up more and more shares of SCHD almost on a weekly basis. This is a chance to get many wonderful companies at a discount and at a really high starting dividend yield of 3.8%. That means I'll get quarterly payments from over 100 companies when they share some of their profits to investors. This really helps during times like this when SCHD isn't doing so hot. But I know if I play this in the long run, don't focus on short-term tunnel vision, I'm going to be walking away with some juicy profits. Almost as juicy as the conversations we're having in the Dividend Discord chat, which you can join for free below. Just make sure you hit that like button for a small-time YouTuber and subscribe for more future updates. I got a ton of dividend ETFs and stock reviews I want to cover on the channel. My videos are always found in podcast form under the Collect Cash podcast name. Let me know what you think of SCHD in the comments below, and I'll catch you on the next one.